Good morning and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. First of all, a very happy New Year's Eve to all our viewers. Whether or not the bulls show up, that's something that we will be watching out for, given the fact that yesterday we did see the bulls wrestling with the bears and trying to, end the day in the green. But of course, didn't really manage to do that. But still, we did pretty well to recover from the day's low, in fact ending extremely flat for the day. So yes, the bulls did try to make a comeback yesterday, but today whether or not they show up, whether or not it will be a party for a New Year's Eve party for the bulls, or whether it will be the year-end blues that will be at play, that's something that we will of course be watching out for in today's session. But if you talk about the year as a whole, a 9% rally on the Nifty compared to a 76% rally on Kospi and other global markets also doing extremely well. Of course, we know that it has been a year of massive underperformance for the Indian markets, but given the kind of roller coaster year that we've had, wherein we were once at the 21,700 levels, and we've done pretty okay to actually end the year with high single digit gains. So that's one positive factor that we would really like to focus on. That despite it being a roller coaster year, the markets did well, especially the headline indices, to clock in gains of somewhere around 9% or thereabouts. But of course, the GIFT Nifty this morning is looking fairly positive, looking like it looks like we are poised for a mildly higher open. Other global markets, Kospi and Japanese markets, Nikkei, are shut, but all the other markets are trading with a negative bias. So yeah, there is some bit of a subdued trade at play when it comes to global indices. But let's see how things really pan out for us. Lots in store. We will be getting your big market voice to share his 2026 outlook. We will be getting our technical expert to share some stock recommendations for the next year as well. And keep your stock related queries as well coming in. We'll try and get them addressed during the course of the show as well. But before all that, let's take a quick look at the top stories at this hour. Wall Street ends lower for the third straight session as year-end approaches and volumes dry up on Wall Street. Tech stocks continue to fall, with Nvidia posting its third straight day of losses. Fed minutes show officials were in tight split over the December rate cut. Asian markets open largely lower, tracking the cues from Wall Street, with the Japanese and South Korean markets being shut today. The GIFT Nifty is indicating a flat start for the Indian market. Precious metals rebound after falling sharply in the previous session, with the silver prices hitting yet another high, and gold of course also rallying above that $4,360 per ounce mark. Oil prices, however, remained largely flat after a choppy session as peace talks or peace hopes between Ukraine and Russia fade and tensions flare up in Yemen. And in some changes effective today on the derivatives front, stocks like HFCL, NCC, Titagar Rail and Cyient will move out of F&O segment, while Swiggy, Vari Energies, Premier Energies and Bajaj Holdings make an entry. Separately, lot size for Nifty contracts has been revised to 65 from 75 earlier, and for the Nifty Bank Index to 30 from 35 earlier. And Prime Minister Modi meets economists ahead of the union budget. Sources say the discussions covered diversifying export markets, capex push, structural reforms and steps to boost household savings. All right, quickly taking you through the setup for today. Recapping yesterday's session first. Markets were in a range. It was the last F&O expiry of 2025, and of course it was fairly choppy, and we were trading in a 100-point range on the Nifty, but we did well to recover from the day's low and end just about flat with a negative bias. But the bulls did make a comeback. We did see some green on the screen across the day sometime, but all those gains kind of fizzled out. But still today we'll see whether or not the bulls are in a mood to party, or they will be gripped by year-end blues, as has been the case in the last few sessions. Banks were of course relatively outperforming. PSU banks saw buying interest. Autos and metals rose in a weak market. In fact, the Nifty Auto Index was gaining 2% ahead of the monthly wholesales data that will of course come out tomorrow. That's the 1st of January. But in terms of the options queues, I already mentioned that there will be some changes in the derivative markets that of course will be watched out for. Put call ratio on the Nifty jumped to 0.92 vis-a-vis 0.68 in the previous session, and Sammaan Capital will be coming out of the FNO ban today. It has been in FNO ban for quite a few sessions, but today it will come out of that ban. But on that note, let me bring on board Ajit Mishra, Senior VP Research at Religare Broking, to talk about the setup, to talk about how 2026 is looking like, and what are the recommendations for 2026 as well. Ajit, lovely chatting with you. Very happy New Year's Eve to you. Of course, most of us are not in the mood to really work today, but no option. Markets are open, and markets are open tomorrow as well. Yesterday, of course, it being the FNO expiry, we saw a fair bit of volatility. But the bulls did try, to make a comeback, and we did see a good recovery from the day's low. What's it looking like today? Are we going to follow through with yesterday's strength that the bulls exhibited, or do you think it could be another range bound, boring sort of day, because volumes, of course, are expected to be thin any which ways?
Yeah, good morning, Nandita. So first of all, wish you a very happy new year, and to the entire team, all the viewers. So yes, consolidation is continuing. The last fifth, we are in the fifth week of consolidation. Volumes are thin. Activities on the stock specific front from the sectors which have been performing well for quite some time, like banking, auto, metals. Rest of the pack on the rotational basis are definitely offering stock specific opportunity, but broadly we are stuck in a range. This 500 points range, 25,700, 26,200 is something that we have been hovering in for last 5 weeks. So until we see some decisiveness, either side, I doubt that we are going to see any meaningful directional trend in the index. The good part is that banking index in yesterday's trade showed strength. On the monthly expiry day, it managed to hold the key support area around 58,700 mark, and ended around the day's high, while the Nifty was still struggling. So this gives us comfort that at least the trend is not going to reverse. Means within this consolidation, it's more of time-wise consolidation or correction that we are seeing in the markets. And the moment we see the alignment strengthening further, especially from the banking and IT pack, probably we are set for the next leg of the up move. But in the interim, stay stock specific, focus on the key sectors like banking, auto, and metals, and pick selectively from the others.
Okay, stay focused on those sectors that I know Ajit just mentioned. But Ajit, of course, metals, banking, these are some of the pockets that are exhibiting strength. But what about IT? Yesterday we saw fifth straight day of losses. For the year as well, the IT index, I think it's down somewhere around 12% or so. Although if you see the last 3-month returns, IT has done fairly well. But what does it look like, on a longer term basis, with the 1 year perspective? How would you look at IT?
So yes, though we are seeing profit taking in the last 2 weeks, but situation is comparatively better to what we were a couple of months ago. Because earlier we were struggling around the long-term averages, means we were underperforming big time on the IT pack. But at least now we have some bit of stability at, or some of these stocks, they are still holding around the record this 52-week highs. So selective buying approach is something that you should be focusing on. So stock from the mid cap IT basket like Persistent, TechM, from the large cap IT names, TCS, Infosys, HCL Tech. So these are some of the names that you should be selectively looking to accumulate on dips. Yes, for the index to make a meaningful recovery, 39,500, the previous swing high, is something that the IT index should decisively surpass. Then we'll see the actual momentum coming in the IT pack. But at least the downside seems capped from the current levels. So selective buying can be considered, of course, with the strict stop losses.
Okay. All right. Any recommendations, since it's the last trading day of the year? Any trading recommendations for today for our viewers?
Yeah, certainly. So, see, while we are seeing some of the sectors, they are anyways doing well. From the other pockets also, we are getting decent opportunity. So from the pharma space, Glenmark, after this recent decline, looks set for next leg of the recovery. It's overall comparatively strong within the pharma space. So we expect this stock to inch toward 2130 mark in the near future. So with stop at 1980, one can accumulate Glenmark at current levels. Then we have UPL, which is outperforming within this chemical basket. The stock has almost reached to its record highs. Traction with the volume is something which we are anticipating. So 820 is what we are eyeing next as a target zone for UPL. So with stop at 772, you can accumulate UPL also at current levels.
Okay, UPL and Glenmark trading picks for today. Of course, for 2026, I'll ask you your recommendations later on in the show. But there have been some changes with respect to Jan series as well. We've had a couple of, or in fact, 4 stocks, entering the FNO universe and 4 stocks exiting. Swiggy, Vari Energies, Bajaj Holdings, Premier Energies. These are some of the stocks that will be entering FNO from today. Any of these names that would catch your fancy, and what about the exclusions? We've had, HFCL, NCC, Titagar and Cyient. These are being excluded. So how would you approach these 8 stocks? They will be in focus today for sure.
Yeah, so usually we see bit of a traction, especially on the inclusion part, and Vari Energy after this decline from its record highs, we are trading closer to the long-term averages. So possibility of consolidation is high, and decisive break above 3180 can fuel the next leg of recovery in Vari at current. Rest of the counters, they are largely witnessing consolidation. Like Swiggy, we have hardly seen any kind of momentum. While Eternal is also struggling, Swiggy is also hovering in this tight band of 420 to 375. So as of now, indications are mixed. So selective approach means the moment we see a bit of a stability, then only you should approach these counters. For the exclusion part, Titagar definitely looks promising, because of late we were seeing some of these railway counters witnessing strong recovery. Yesterday it was slightly down. In case if we get any dip towards 850 levels, then probably we might see the next leg of rebound also in this stock.
Okay, those were all the stocks that will be included and excluded, and how to approach them really. But let's take stock of the markets. Of course, 26,000 back on the screen, and it's a good 60-70 point up move on the Nifty. So looks like the bulls are getting into the party mode. Whether or not they extend this up move or not, we'll have to see as we progress through the day. But for now, it's a 200 point move on the Sensex. Even the mid cap index is looking fairly upbeat. In fact, it is outperforming the benchmarks in early trade, and the breadth of the market is also looking fairly encouraging. After breadth being poor in recent times, we are seeing the NSE advance decline ratio at 2:1, 1430 advances to 712 declines. And if you look at the Nifty gainers, you're seeing more, in fact, Nifty movers, you're seeing more of gainers than laggards. The gainers list is far bigger than the laggards list. So yeah, that's something that one would take heart from. Bank Nifty as well extending yesterday's gains above that 59,300 mark as we speak. And sectorally, it's the metal pack hands down. That's the top Nifty, in fact, top sectoral gainer. For the week so far, the Nifty metal index is up in excess of 3%. And of course, year-to-date basis as well, the index, is the second best performing index, sectoral index, 29% gain so far for 2025. In terms of the other sectors, you have real estate beaten down this year. It's down in excess of 20%, and some slim gains coming in there, 0.5% gain on the Nifty real estate segment. Yesterday, realty was among the top laggards. IT is also staging some kind of a recovery after a 5-day sell-off. IT is up somewhere around 0.3%. Pharma, banks, FMCG, autos, all of them are trading with gains at the current juncture. In terms of the sectoral movers, then top 2 Nifty gainers are from the metal pack, JSW Steel and Tata Steel. In fact, JSW Steel is rallying in almost 3.5%. Tata Steel 2.5% up. BEL, Bharat Electronics, defense stocks have had kind of a iffy ride so far this week. But today BEL is looking good, 1.5% gains. Of course, we've had the DSC clearing proposals worth 79,000 crore rupees in recent times, and defense stocks were in focus ahead of that as well. Adani Ports among the gainers, Jio Financial, Max Healthcare. Max Healthcare, mind you, was among the top laggards yesterday. Hospital stocks were on the back foot, but today some buying interest emerging, and Max Healthcare gaining somewhere around 0.7%. Jio Financial is also up. From the private banking lot, Axis Bank, Kotak Mahindra Bank, those are among the gainers. Reliance Industries also up by 0.5% or thereabouts, and some traction in names like Trent that have been beaten down. In fact, Trent is among the top laggards on the Nifty for this year, down 40%. And today, some bit of buying interest in Trent as well. On the flip side, Gainers, laggards list is pretty slim. Aisha Motors, M&M, they are topping the laggards list. TCS and Wipro also among the laggards, even though the IT pack is trading in the green. Metals, of course, you already touched upon metals that, that sector is in traction. So look at stocks from that universe. But what do you do with the likes of Hindustan Copper and Hindustan Zinc? They have rallied in tandem with the global metal prices. Would you say that those two stocks are looking overheated on the charts, and it's perhaps time to at least book partial profits on those two counters?
So certainly, because the kind of move that we were seeing in silver, so it's largely reflecting the same. And now, after this recent cool off from $80 mark in the silver, we expect a bit of a consolidation in profit taking. So yeah, the prudent approach, at least to book partial profit, 50-60% at current levels, and do maintain a trailing stop losses also. Means for Hinge Zinc, a level close around 600 seems apt, because below this, it can extend this decline towards 570 levels also. And same holds true for Hind Copper, though it's look comparatively stronger. Means yesterday also there was a strong advance. So in case if it manages to hold 490, one can definitely stay put. 540 is going to be the area where we have the immediate resistance. The moment we cross, we might see further gains.
Okay, that's about Hindustan Copper and of course Hindustan Zinc as well. Let's talk about some of the stocks in news then. Since we are talking about the precious metal lot, I just want to talk about Muthoot Finance as well. Gold prices have also given very solid returns for the year. The likes of Muthoot, Manappuram, would any of these catch your fancy to ride this gold theme? Muthoot Finance is also in focus, given the fact that it has bought somewhere around 3.3 lakh shares of its arm Muthoot Money to raise funds worth 500 crore rupees via rights issue. That's the news bit. But any of these stocks, Muthoot, Manappuram, on your radar?
So Manappuram definitely looks promising. Muthoot, outperformed in the recent run, but after this recent consolidation range breakout, we are seeing that Manappuram has more legs to the upside. There's a range 295 to 65 is what it was hovering in for almost like a couple of months, and of late we have seen a breakout from the same. So this marginal pullback is basically a buying opportunity to those who missed the rally earlier, and 295 on the positional basis should be your stop loss, with the positional target of 345 to 355.
Okay, that's about Manappuram. That's looking better on the charts compared to Muthoot. But I just want to take stock of some movers for the year 2025. Tata Motors passenger vehicles. Of course, the split happened recently. But Trent from the Tata stable, that stock is down 40% for 2025. 2024, it was the showstopper stock, right? How would you approach Trent after this, kind of sharp drawdown that we have seen? And even TCS for that matter, that stock is losing 20% on a YTD basis. We did discuss IT, but these two top laggards of 2025, how do you approach that? Is it a good time for a positional bet, or is it a complete avoid at the juncture? Both these stocks.
Yeah, so first talk about Trent. So yes, you were right that in 2024 we have had a exceptional run. In the month of September, we tested the high of around 8,000 mark, and from that zone to almost 50% kind of a retracement, we've almost tested a level close to around 39.50, 39.30 on the downside, a couple of weeks ago. And now we are seeing a bit of a consolidation, or breather at least. So it's not completely out of woods. For any decisive reversal, we need to have something a formation on the daily chart or a weekly chart. So which is not the case yet. But yeah, the downside seems capped, because we have strong support of this close around 3,900 mark on the weekly chart, which may act as a strong cushion in case if the consolidation extends. Upside 43.50 is the immediate resistance. The moment we cross, then probably we can see a decisive trend unfolding, which can help the stock to inch toward 5,000 or maybe higher. So as of now, it's an avoid, but yeah, a decisive close above 43.50, definitely one can look for long opportunities with 4,200 as a stop loss and 4,800 to 5,000 as a target zone. TCS, like any other IT major names, but comparatively, if you see that within this space, HCL has done exceptionally well. TCS is making attempt of a rebound, but this zone close to around 3,300 is acting as a very strong hurdle. So in fact, this entire zone 3,300, 3,400 might continue to act as a hurdle. So in case if it remains, with the sideways bias, a downside 3,100 is something that we anticipate as a support. So broadly, this 300, 400 point kind of a range is something the stock might continue, at least in the near future. A decisive close above 3,400 would change its trajectory and will gradually see the stock inching towards 3,700 mark or maybe higher.
Okay, that's about Trent and TCS. But another stock that's in focus today is MCX. Morgan Stanley has upgraded the stock to equal weight, and the target price has been raised to 11,135. The stock, of course, has clocked in gains of somewhere around 75% for the year, and even in the last 1 month, if you look at the last 6-month charts, you've seen good gains coming through. 11,200, that's the 219, that's the 52-week high, but it's at 11,077 or thereabouts. How much higher can it go from here? Do you think the steady uptrend that we have seen in shares of MCX would continue here on? How do you approach this stock now?
So it's a very consistent mover, in line with what we are seeing in the commodity prices, which is reflecting here also. Means the stock has gained post this consolidation range breakout from 8,500 to 11,000 plus zone now, and still we are seeing that every dip the buying interest emerges. So yes, you can continue to hold your longs. You can still look for long opportunities. 10,500, that should be your stop loss area. Upside is open since we are at the record high, so one should not concerned about where I should put my targets. As long as the trend continues remain the positive side, you can continue to trail your stop losses. Means the moment we, let's say, surpasses 11,500 600 zone, you can trail your stop loss to 11,000 levels and ride this rally.
Okay, that's about MCX. But let's talk about a newsmaker. Big, large trade has happened in Privi Specialty Chemicals. Equity worth 9.9%. 9.9% equity worth 1,086 crores has changed hands at 2,799 rupees per share. The stock, of course, is showing down somewhere around 13% or so. We have a few queries as well coming on this particular counter. I think it was Naveen that had sent the query on Privi. How would you approach this stock? Any kind of major breakdown that you are spotting after today's move on the back of this block deal?
So yeah, it looks sideways to weak to us. So as long as we are not seeing anything decisive, at least on a weekly chart, means some sustainability at the higher end, one should refrain from any aggressive longs. In fact, within this space also, some of these stocks they have already done well, but sustenance is something which is the key, which is the missing link as of now. So UPL definitely from the chemical basket is something that you can consider, which we have recommended as a trade also for the day.
Okay, that's the view. I hope that answers your query as well. And of course, it is a newsmaker, given the fact that the large block deal has happened, and as a result of that, you are seeing a 12 to 13% kind of cut on the share price. But let's take up some viewer queries then. On that note, talk about a Canara Bank. Mohit has written in, wants to know your thoughts on whether it's a good time and price to add Canara Bank at current levels. Canara Bank, I think, is one of those mid-sized banks that have done extremely well along with the Federal Bank. So would you look at Canara Bank from the mid-sized banking lot, or would you prefer something else?
So, after almost like 2-3 weeks of consolidation, Canara Bank has reclaimed its record high in the last trading session with noticeable surge in the volume. In fact, the entire PSU basket, banking basket, looks comparatively stronger than the private payers. So, yes, you can definitely look for long position. In fact, as a disclosure, we have recommended this to our clients also today. What we are eyeing is 164.65 as a immediate target with stop at 148.
Okay, that's the view with the stop loss at 148. You can look at the shares of a Canara Bank. Hope that answers your query. Okay, Privi, we've already answered. Let's take up a query from Alex on Bharat Forge then. The stock was in news. Some contracts it has signed, some defense contracts that it has signed. The stock, is trading with good gains of 1.5%, and it has seen a fairly okay kind of traction in the last 1 month as well. On a YTD basis, it's up somewhere around 13-14%. At 1479, is it a buy? In fact, I think it hit a fresh 52-week high today itself. How would you approach this counter now, and what are the next target levels to watch out for?
Yes, so in fact, we are seeing a very steady recovery post this, phase of decline, and in fact, the stock has formed a fresh buying pivot while holding up the short-term averages. So trend looks positive, and this zone close to around 1440 is what we have as the immediate support. So with that as a stop loss, one can definitely look for fresh long positions. 1550, 1560 is going to be the first area of resistance. Then 1650 is something that one can eye as a positional target. So risk reward is also favorable. You can consider going long with 1440 as a stop loss.
Okay, that's about Bharat Forge. Well, I hope that answers your query. But let's take up a query on shares of GIC. Not getting this person's name, but he holds shares of GIC at an average price of 280. Wants to know whether he should accumulate more at current prices. He's making a profit here. Should he accumulate more, or how should he approach?
So yes, he can consider accumulating, because after this phase of consolidation for almost 1 year, we are seeing the stock has been hovering in this very tight band, and probably we see an attempt of a breakout in the near future the moment we cross 400, 410 mark decisively. So with stop at 360 as a trailing stop loss, he can consider adding to his position. Around 430, 440 is something that he might consider booking profit if the view is short term.
Okay, that's the view. You might consider booking profit as well. Hope that answers your query. But let's talk about some of the other names as well. The likes of Lupin. The stock is in focus because it has. In fact, its Netherlands arm has signed a pact to buy 100% stake in a pharma company. The stock is trading with decent 0.7% kind of gains, but within the pharma pack, how would you look at some of these players like Lupin, Dr. Reddy's, Sun Pharma? A lot has been spoken about weight loss drug as well, as to how that could emerge as a revenue driver for some of these companies. Would you look at some of these names, or would you tilt more towards CDMO names?
So basically both, because what we are seeing is it's been almost 1.5 years of consolidation in most of the pharma names, wherein Lupin, Sun Pharma, Dr. Reddy's, Divis, they were among the top performing names. Means we started seeing the rebound also, and I believe that in 2026 pharma can positively surprise the market, because the kind of overhang that we had, especially due to the tariff related challenges and all, that might subside, and eventually this kind of 1.5 year of consolidation is likely to end. So probably we can see the next leg of surprise positive swings from the pharma majors, and Lupin is also likely to participate in that move. So in the next run, probably 2250, 2300 is something that the stock might attempt from the near term outlook also. So with stop at 2040, one can accumulate at current levels also.
Okay, that's about Lupin. Just one more query. In fact, because the stock is buzzing, I would like to touch upon it again. I know we already discussed those F&O inclusions and exclusions, but HFCL in particular, the stock is up 5%. It has been a consistent underperformer. In fact, it has been under severe selling pressure. Look at the YTD moves; it's down over 40%. And even the monthly, 6 monthly, 3 month basis, you look at this stock; it has only given negative returns. Suddenly some bounce of 5% or so, and that too after its exclusion from the F&O universe. How would you read into this? Is it just like a flash in the pan, some buying interest emerging? What are the charts saying? Do you think the setup looks bearish from here? And how should one approach this stock? There's a query on this from Vishal Dave as well.
Yeah, so My suggestion to Vishal is that yes, we are seeing the rebound. The stock is up roughly around 8% from the key support zone from the last time. Also means this level close to around 60 was the zone basically where we had the major consolidation last time, and that's why we are seeing this recovery. But we are completely not out of woods. Means 68, 50, 69 is still a very strong hurdle. Until we decisively break this mark, this recovery may fizzle out. So as of now, this 64 should be your strict stop loss, Vishal. And in case if we manage to surpass 68, then 72 to 77 is something that the stock might test. So as of now, it's a hold with a strict stop at 64.
Okay, strict stop at 64. That's the view and that's the advice. Hope that answers your query. And there's a query on HUL as well that's just come in. Not getting the person's name here. Of course, they want to know that, some of these FMCG names like HUL have been underperforming. And of course, they haven't really been able to fire up despite the GST cut announcements. One would have thought we will see, a good fillip, but, kind of fizzled out even during the tax cut announcements in budget last year. They did see traction for some time, but, didn't really manage to fire up so much. Last 1 month or so, it has given negative returns on a YTD basis. It has done absolutely nothing HUL. So any thoughts on this particular counter? How should one really navigate this?
So it's been almost 4 years, Nanda, that the stock has done nothing. Means in terms of the price action, 2000, 2700, 2800 is broadly the range that's been hovering in. You were right that post the GST cut announcement, we were seeing a bit of a traction, but it failed to hold those gains. And again, we are back to the square. Still, we are not seeing any decisive sign of reversal. So maybe market might be waiting for earnings for a volume uptake so that they can take a decisive call on this stock. But within the FMCG space, stock like Britannia, Marico, they are the better place counter. Then we have Godrej Consumers also, wherein we are seeing strength. So as of now, HUL is an avoid. You can consider any of these names from the FMCG basket in case if you're aligned only to the same space.
Okay, that's the view. HUL is an avoid, but all those names that Ajit mentioned, you can perhaps look at them. But Ajit, I just want to get in your thoughts on some of the star performers from the mid-cap universe for 2025, the likes of Force Motors and Ether Energy. These two stocks, I think, 200% or 3x returns for Force Motors and Ether as well. The stock has, of course, more than doubled. How would you approach this stock going forward? They have been the showstopper stocks for 2025 from the Nifty 500 universe.
True. And in fact, Ananda, this auto as a pack has been outperforming in the last almost several months now. So we believe that this outperformance is likely to stay. And Force Motor, after this marginal profit taking phase, has rebounded very strongly, and we are gradually inching towards the record high. So definitely, it looks promising. Means you can continue to hold your longs. 18,700, 750 is the area where we have multiple supports. 21,700, 750, the record high zone is something that you can maintain as a target. Same hold true for Ether also. Means it's a very similar structure that we are seeing in both these stocks. Means after a marginal correction, we are again seeing the stock is inching towards the record high. 780 is something that it might actually as a immediate resistance, with 725 as a stop loss. So very short term, it may witness a bit of a breather around the record highs, but overall trend looks positive. So you can definitely consider long position here also with 725 as a stop.
Okay, that's the view on those two showstopper stocks of 2025. But this wraps up our query segment, our very last query segment for 2025. But before we move further and before I let you go, Ajit, talking about the Nifty levels to watch out for 2026, what is your outlook on the technical front for December 2026? What would the target be? And also share your recommendations for 2026 for our viewers.
So yes, it was year of consolidation for us. Means in September 2024, we were at 26,277 mark. Though we managed to cross this zone of late, but we are seeing bit of a consolidation. So it's a very healthy sign, and that means this shows that after this phase of consolidation, still like for the 10th consecutive year, we are seeing that Nifty is posting, positive return. And after this consolidation, it has basically made a ground for the next leg of the up move. So I'll not be surprised if we test 28,800 mark by the end of this year in Nifty. And sectors which are outperforming at present, so be it the banking, auto, metal, they might maintain their outperformance in the coming months also. So the focus should be more on the sectors and identify the outperformers within this space. So let's say from the auto space, Eicher, M&M, TVS, they are the best names which are consistently maintaining the positive trend amid marginal consolidation in between. Then we have from the banking space, SBI from the PSU basket, Kotak, HDFC, wherein we are seeing outperformance or at least sustainability at present. And metal, of course, after this strong surge, yes, we may see bit of a consolidation, but stock like Tata Steel, JSW, Jindal Steel, they still look promising from the current levels, which can yield decent returns in the next 1 years.
All right, with all those stocks and of course those nifty levels to watch out for, optimistic view coming in from Ajit. Ajit, would like to thank you on that note for taking out time and joining in. Always a pleasure, and I wish you a very, very happy and profitable 2026. 2025 has been a year of muted returns, although we did hit record highs and we did actually well to end with high single digit gains. But let's hope 2026 will be a much better year for portfolios, because that's really not been the case in 2025. Wishing you a very, very happy new year, and I look forward to more interactions in 2026 as well.
Thank you so much, Nandita, and I wish you the same, and all the viewers. May they have much more profitable year. Their small caps also start performing is something that I wish for.
All of us have our fingers crossed, Ajit. With that, thank you. Thanks a lot.
Thank you.
Well, on that note, just quickly take a look at the market. 63 points up on the index, 26,000. We're maintaining that level, so that's a good thing. New Year's Eve, something good, to end the year with, if we manage to end above that 26,000 level. But on that note, big market wise, Bala Subramanian, MD and CEO, Aditya, Birla, Sun Life, AMC joining in. Bala, great to have you on the show. Very happy New Year's Eve. On one hand, one should be happy that we are ending a roller coaster year with a high single digit gain on the index. But portfolios aren't feeling all that happy. Most of the portfolios would be staring at losses of 15 to 20% or so for the year. So not a very happy feeling as such. So going forward, do you think 2026 could, prove to be better when it comes to individual portfolios? What is your outlook at ABSL, AMC? How are you looking at the markets for 2026?
Well, thanks, Nandita, and wish you and all the viewers Happy New Year and great year ahead. See, 2025, I will not call it as a bad year, given the fact that while single-digit return is also part and parcel of the market, a negative return also is part and parcel of the market. I think the way we have to look at 2025, one, not only is the year of consolidation, against all the odds that were actually coming and hitting against India, I think Indian market has done far better. When I should not measure only on the basis of return alone, even the way the government rolled out various steps in the last year in order to get back on growth momentum. But as I speak today, yesterday the government of India has released that we have gone past Japan in terms of GDP number. So therefore, year 2025, I would say consolidation year, and we are closing nicely. And then whenever the market corrects, of course, any excess that gets created in the previous 3-4 years in certain segment of the market, I would say sometime get corrected. Therefore, is a function of that. So as we move into 2026, I think the way we see is that as well as like mutual fund, we are getting into a good year where the last 1 year of consolidation has made the valuation to become reasonable. And second, the interest rate cut that has been done the entire the period of 2025 should start resulting in credit growth picking up. Therefore, we will see the economic growth continuing and it's getting better. And third is GST reduction that came in last year. I should also actually boost the consumer sentiment, and therefore consumer spending should also rise in the year 2026. And this will be supported by the earning growth coming back. Therefore, we believe that 2026 is going to be a year where the stock market should do well, better than of course 2025, with the somewhere expectation of return somewhere anywhere between 12 to 14% kind of return expectations that should have for the year 2026. I think basically we should start with reasonably good positive vibes. And lastly, we also believe that this year, given the fact rupee dollar has gone to about 93, and we see 2026 year where we'll see a reversal of FA flows in the year 2026. That's something we believe would happen for two reasons. One, whichever the country they look at it, let us assume a scenario that OpenAI current debate that is going on, whether it is whether there will be some bit of pressure or bubble kind of things. But assuming something happens, even marginally on that segment, if the US underperforms, clearly having seen significant outperformance coming from markets like Japan, Hong Kong, and China and Korea, then naturally Indian market will become attractive. Plus, rupee dollar being at 91, they'll also expect some bit of appreciation to happen. Therefore, reversal of flows in the year of FAS is also equally high in the year 2026. Therefore, it will be a combination of both domestic flows and FI flows, and valuation being relatively moderate should drive the sentiment.
Okay, quite a few pointers you mentioned there, and of course the most important being the fact that India of course has overtaken Japan as the fourth largest economy. Of course, in terms of growth rate as well, we are one of the fastest growing markets in the world, in fact global economy in the world. But going forward, in terms of US markets, I want to talk about that, given the fact that we've seen US markets giving returns in excess of 20% for the year. Towards the end of the year, we've had concerns about the AI bubble bursting, so to say. So how valid are those concerns? And going forward, do you expect US markets to temper down a bit right away, or do you think there would be some more outperformance coming in from US markets before things cool down a bit over there?
I think a lot of the questions and debates have been going around, and the biggest capex that is being talked about in the world, in the US, is actually investing in OpenAI, and that's the biggest. Whereas the way I look at it, any capex that you make has to create an assets. We should be able to see the assets and that be able to produce results. Of course, AI is a new animal where it produces, of course, generate revenue. At the same time, the assets can actually can create some kind of uncertainty since it's not the real assets. Therefore, it's something, it's a dilemma which of course is down. Then how much of the discount that you can pay with respect to the value that you create in terms of volume versus value of profit that you can create? These questions actually will come. We must also admit that the last 2 years there has been a significant run in this segment of the market, and any slowdown that we are seeing in the US economy, or maybe even if there's no slowdown and economic continues to remain strong, will also lead to the expectation of rate cut may not come as much as people are expecting. Therefore, the US is more market, and a lot of uncertainties is still hanging sword as a country, which is including the fiscal. Therefore, we'll have to just still watch and watch. We'll have to still wait and watch in terms of how it will pan out to be. But I think some bit of if you play some bit of cautious approach, there's a high probability that we might see some kind of uncertainty in that segment of the business. So if that comes, then naturally people start looking at not alternate so much, but at least some kind of diversification. See, so far the last 3 years, India has been is the only market where they have been taking money out, and they have been putting money in the rest of the countries globally. Of course, I would always say, looking back, maybe they are smart, and it paid out quite well for them. But given the fact that somewhere the Indian growth rate is more consistent, and the reform three that government of India is talking about would also, of course, see some more mention about this thing in the budget, and therefore the confidence may get further boosted. And broadly, we still have a fiscal room to drive the economic growth. Indian fiscal, despite GST cut, while there has been a marginal slippage in fiscal number, but the way I look at it, will we have enough fiscal room for us to spend money? Obviously, the answer is yes. Will we have enough scope for actually step up their capital capex in the country? Obviously, the answer is yes. And these two being more favorable for the growth to become more certain, then we would probably have to expect the flows to reverse towards India. Therefore, some of these uncertainty that could come for the global market, especially US, will probably see some of diversification would come. I'm not saying US is a big market, despite all the odds that they have done far better. And it's the only market where it continues to focus on innovation, bringing in new way of doing business. Therefore, one cannot completely ignore the US market from a broader asset allocation
Sure.
point of view. But however, having seen significant outperformance and some bit of uncertainty which is coming in, which is currently is being talked about, that's something we'll have to just keep in mind. Even, for example, last week, JP Morgan had announced roughly about $4.5 billion potential provision that they have to make on certain segment of the market, on private credit market. So these are some of the things we'll have to see whether it is the beginning or is one of this for which we do not have an answer right now.
Okay. All right. Of course, those are some significant risks when it comes to the US market. But from an Indian standpoint, when I was talking about AI, we've seen a large deal happening between Coforge and Encora, AI deal. Do you think AI spends and data spends investments will define IT spends in 2026? Could that be, one area that could, the IT companies be spending in next year, especially after this mega deal that has happened?
Actually, yeah, I think the spending towards IT is directly correlated to the interest rate movement. Historically, if one has to look at it, if the expectation that has been set in terms of rate cut from Fed, if it continues, then naturally the spending towards the IT will increase. And AI is something I think everyone do not have much choice but to make some kind of investment and get prepared themselves for the new world that is coming in the field of IT and technology side. Therefore, it's an investment that the one has to make. But within that, we will find, I think most of the even Indian companies, gradually getting prepared for some bit of investment in that space because it's something you cannot ignore it. It's a new world which people will realize only after say 3-4 years. But being prepared for such kind of transformation that could come in the technology space, something will remain as we will find some of the M&As valuations may fetch a higher premium and so on and so forth. So that's something will be there. But I think the way I look at it is at least the IT spending, which probably would have remained somewhat silent for quite some time, may gather some kind of momentum the year 2026. Therefore, we also believe the Indian IT companies could also be one of the contra play in that sense.
Okay, all right, got your point. But let's also talk about the overarching theme for 2026. You said that the government, of course, will have more room for fiscal spending. But of course, they've already done quite a bit on the demand side as well, right? How should one position their portfolios in terms of, what would be the overarching theme, manufacturing or consumption? For 2026, if one has to focus on a particular area, which one should get the most, attention for 2026?
I think if you look at it broadly, I think government capex will continue, and the manufacturing focus that has come in the last few years that will continue. But however, the consumption as a segment has remained somewhat underperforming for the last 4 or 5 years for a variety of reasons. And the recent push on GST, I think first time ever in the last 10 years, they have moved away from, not moved away, they have actually government has given simultaneous focus to improve the consumption in the country. One way of cutting interest rate and second way of cutting GST which is nothing but plus also the 8th pay commission. The outcome when it comes for 2027 effective would also actually boost the income in the hands of people. And lastly, is the agriculture income continues to remain very, very strong given the good monsoon. Agriculture output has been very, very strong. Therefore, rural income is actually not so much impacted. Therefore, the consumption-led theme I think will work out. Clearly, the consumer durables have not seen much demand so far. I think that maybe the change of mindset, I see it happening in 2026. Therefore, the consumption-led growth should come. Of course, it is something one has to see in terms of various sectors within the space. It is a wider sector within the space, but definitely is the within that segment we will see some bit of pickup coming in by way of increased spending that could come from the consumer at large on the basis of some of the booster that has been given to encourage people to spend money.
You know, autos have been one of the biggest beneficiaries of the GST cut, right? And we've seen that play out in the stock prices as well. But do you think the best of the GST-led rally is out of the way for autos? You know, how should one approach autos within the consumption pocket now?
So I think as it stands today, basis the narrative that is coming from most of the auto dealers as well as auto manufacturing companies, especially the passenger vehicles and two-wheelers. I think they continue to post brave outlook for the year 2026. The whatever the kickstart that we had post GST reduction, they dropped the prices, and today the prices are quite affordable. So one of the area where we always used to have a challenge is the price on the road, including the price at the factory and the price on the road. There has to be a huge difference in terms of taxes. The GST ticket coming in, most of the companies have passed on the benefit to the consumer. Therefore, we'll probably see the pent-up demand that I think will continue. Second is with the loan rates coming down, we'll also find financing being available to the consumers, and with the income levels generally is very stable. I would assume our two momentum that we saw in the first 2 months will continue. In fact, certain segment of the market. I think if you have to take what do you call the tractor as a segment, people are also now looking at with the reduction in prices. They are now finding a reason for them to replace their old vehicle with a new vehicle. And at the same time, with the reduction in prices, it includes their return on investment (ROE) for the people who actually let out these kind of vehicles also increases quite significantly. So therefore, there has been the new model which I can say. Even for the passenger vehicles, with the drop in prices, somebody runs taxis, income levels goes up. The last but not the least, in terms of fuel prices being very, very under control, I think government is also pushing alternate fuel usage like gas is also now being pushed, which essentially means from a vehicle owner point of view, as long as there is no cost escalation, and then cost of buying comes down by way of interest rates, then actually the demand should continue even the year 2026. It's not just one-off kind of that we saw a pickup. I think my belief is I think will continue. Including two-wheelers, there has been a continuous growth. Basically, passenger vehicles, two-wheelers, and tractors, which is the momentum. Of course, as far as the commercial vehicles and the buses concerns, it all depends upon how the government spending increases, and also depends upon how the freight rates movements happens on the basis of the economic growth, which I think should be somewhat you should see an upside, if not the worst of last year.
Okay, you know, and also another pocket that I want to touch upon is the entire financial space, especially you know, between banks and NBFCs. Which segment is best poised for 2026? Banks, of course, we saw the Nifty Bank hitting fresh record highs. PSU Bank's best sectoral mover this year. But on the other hand, we've also had margin pressure or, you know, warnings coming in from Axis Bank that their margin will bottom out only, you know, later than what was being expected, only in the fourth quarter of current financial year or the first quarter of the next financial year. So in terms of, you know, margins and, you know, cost of funds, etc., do you think NBFCs are better poised for, you know, 2026, or, you know, how should one approach the financial space?
If you look at the NBFC, sorry, the
Okay, I think there's some audio issue.
and
We will just get it
yeah,
sorted.
Is it okay now?
Okay, we'll just get it sorted. Yes, yes, I can hear you. Go on.
Okay. So I think, Nandita, the financial sectors, you have to divide them into three, four parts. One is the large private sector banks and large public sector banks, and then mid-sized private sector banks and mid-sized public sector banks, and then the NBFCs space. I think within NBFCs we have three, four varieties. But I think the way I look at it, the mid-sized banks and what do you call, the NBFCs will be able to grow faster than the large banks. Therefore, the naturally value creation could be a little higher in that segment of the market. And secondly, the NBFCs will also get access to the cheaper financing. Therefore, the leverage benefit they will get in addition to the rate of growth being faster. And third, of course, is the margin impact would be for them a little less compared to the large banks who would normally depend on the CASA deposits, where if the rate comes down, the deposit accretions could be relatively challenging, and therefore the margin could impacted for banks marginally. But otherwise, if you take a relative performance, I think NBFCs will definitely do better than the banks. But having said that, the way I see is, given the fact that I expect the flows also to increase for India, I think the financial service sectors being one of the largest weight in India in the index, and also given the fact they are in a very solid wicket when it comes to the question of capital adequacy, the lowest NPA, relatively clean balance sheet, and ability to grow, attract deposit on one side as well as the ability to grow on the credit side is extremely high when it comes to the question of the large banks. Therefore, they would remain as part of the large flow of money when it comes in. They will remain in limelight, but relative outperformance that we could expect in the NBFCs compared to the competitors. Even capital market players within the NBFC, within the financial space, capital market players as asset management companies as well as wealth management companies should also do relatively better, given the fact that earnings growth continues to remain good, and then dividend distribution for these kind of names would also remain somewhat attractive. Therefore, on a relative basis, when interest rates are falling, high dividend yielding companies should also do better, so to speak.
Sure, that's about sectors and themes, but if you look at the investment strategy for 2026, what is the best approach to having a well diversified portfolio? We all know that 2025 has been a year where precious metals have sparkled, gold, silver, never seen before kind of returns coming in from these asset classes. So multi-asset funds, should one focus more on that? Do you see more upside after the kind of rally that some of these precious metals have seen, or should one focus more on equity funds like balanced funds? How should one approach the entire strategy for 2026?
We have divided the whole segmentation, and it is one, first and foremost, once you look at a flexi cap and multi cap fund, given the fact that it invests across the market cap, and bottom up stock investing would come not just only from large cap, it come from mid and small cap, a mix of three. Therefore, flexi cap is the one where money manager uses the exercise, uses the discretionary, and exercise is the discretionary, and move between large and mid cap and small cap depending upon their own individual boundary. So that's something is the first choice. Second, of course, is the multi-asset allocation fund. Normally, the question which comes with a 60% static equity, rest of it is coming from other asset classes like fixed income, REIT and InvIT, and gold and silver. That's something should become the natural choice of investing. And third, of course, the balance advantage fund, wherein the money managers actively shift assets allocation from equity to increase the equity allocation. Currently, it's about 54-55%. And then when we see the upward trend starting to come, naturally the exposure to equity will go up as it's about 65. When the market turns negative, the exposure will come down about 43-54. And that should be the third choice. I think within these three choices, what we have been suggesting that investors should continue to focus in building the core portfolio. But in terms of add-on subsequent other schemes, like as I mentioned in the beginning, consumption-led growth that we should see in India. Therefore, a lot of companies in the consumption space should do better than what they've done in the last 3-4 years. Therefore, consumption fund could be part of the portfolio as a thematic category. And I also believe that PSUs and
Okay.
banking funds should also do well. And given the fact that that the indexing that is coming in the banking index, and second is the sector now drawing a lot of attention in terms of FDI investment coming into the segment, as well as the rate of growth in terms of credit growth would be better this year. Therefore, that also could be part of the
Hmm.
thematic portfolio. Therefore, you have to look at it flexi cap,
Okay.
multi-asset allocation fund, and then balance advantage fund. These are the three core categories. On the thematic categories, the consumption fund and banking and PSU fund could be the fifth choice.
Okay, talking about the precious metal basket once again, silver has delivered 2x returns of gold in 2025, right? We've already got a trailer as to how volatile silver can really be. We saw, a 15% crash a couple of days back on prices of silver, and it made a sharp rebound as well from there. Given the fact that it is vulnerable to such sharper drawdowns and such extreme volatility, would you consider gold as a better wealth creation vehicle, or what would your thoughts be as to silver versus gold as wealth creation asset classes?
I think if you look at historically, these two assets are not generally considered as a wealth asset creator. Generally, equity is considered as a wealth creator, and the other asset class has got only storage value. But all of us are proved wrong in the last 2 years. These two metals have done far better than equity asset class. But having seen significant rise, we must also remember the fact that any exit that happens could face its own some kind of volatility. That's why we are saying, as it is, we do not know how much the people are short without having delivery in hand. Therefore, these are some of the events right now. We do not know how much is the price movement is because of short covering, how much is because of short supply, not able to deliver the underlying securities, underlying assets. Therefore, this issue comes up. I think the way I see is both gold and silver would probably be performing lower than the equity in the current year, given the fact we have seen significant rise, and any amount of any news that comes in terms of even somebody wants to sell large quantum of quantity in those two segments could also create that volatility in this space. So therefore, between gold and silver, gold of course then was then silver last year, and gold is something. The one is storage value, and second is usage of gold in terms of ability to monetize in terms of assets monetization, whether it is for the purpose of taking loans, is far superior compared to silver. Therefore, to the extent gold can always have a preference over silver.
All right. Okay. Last couple of questions, Bala. 2025 also saw SIFs or specialized investment fund, that emerging as a buzzword, right? Long short funds, SIFs, etc. It is a fairly
Yes.
complex, product to understand, right? But nevertheless, it became extremely popular. Do you expect this to gain more traction in 2026 and more SIFs to come through?
The same thing is a new one. We saw some beginning in the last year, and we ourselves would probably come out with one scheme in the month of the first quarter of the current new calendar year. But this will have gradual pickup the way the arbitrage fund initially is a slow start. Now it's become one of the large category in the mutual fund industry. I think SIF also I see it to become a reasonably decent category as we move forward. Once all type of SIFs begin to be launched. I think once it begins, right now the SIFs are more the nature of arbitrage plus kind of nature. There is a scope for long short fund to focus on absolute return. There is a scope for fixed income credit opportunities fund. I think as we start seeing these new categories coming in, I think SIFs as a category, we will see the pickup coming in. Sorry. At the same time, the existing
All
categories, I think
right.
large pool of
Okay.
money will still be part of the 60 to 70%, as I mentioned earlier, those core schemes. And SAF could become an add-on to some of the investors. Again, we have to understand The SIP is meant for investors who have taken a minimum check of 10 lakh rupees. Therefore, it is meant
Yeah.
for people who have reasonably better wealth can only participate. To the extent my view is the second would be lower than the larger pie that we are managing.
Okay, with that, of course, you've come to the end of this interview. But Bala, before I let you go, 1 lakh on the Sensex and 30,000 on the Nifty. Is it or would it be fair to assume that we could see those levels by December 2026, or am I being too optimistic? What are your thoughts? A lot of brokerages have said that that could be a possibility.
No, of course, we have been saying that this year we should expect about 10-12% kind of return on equity. I think if you put the simple math on that, I think the moment we see some kind of flows reversing from FIs, I'll not be surprised that we come closer
Huh.
to both 1 lakh as far as Sensex and 30,000 as far as the Nifty concern.
All right, on that optimistic and buoyant note, of course, I'll have to let you go, Bala. Lovely chatting with you this morning. And, before I let you go, wishing you and your entire team a very, very happy new year, a profitable one. And, of course, I hope to continue having these conversations with you, very insightful. And I would like to thank you for joining us whenever we requested you. And I hope to see that happening next year as well.
Definitely, Nandita, I think it's always a pleasure talking to you and give my views in the best possible manner. And I also take the opportunity to wish all of you a great year 2026. I'm sure, as we expect every year, this year will be more peaceful and wealth creating year for everyone.
Thank you. Thanks a lot, Bala. Thanks a lot. Well, that was Big Market Voice with his Bala, with his outlook on the markets and, of course, the themes to watch out for in 2026. But let's take a look at what the screens are telling us. And, good thing is that we are seeing a lot of green across the screen today. In fact, the breadth of the market has also improved further. 5:2, that's the NSE advanced decline ratio. So that's something one would take heart from, given the fact that broader markets are doing well. So portfolios would be looking much better today on 31st of December. So yes, the New Year's Eve, also, has turned a little more, better for investors. The Nifty slightly below the 26,000 mark. Nevertheless, it's a 55-point uptick. Sensex up 85 points. Paired some of those opening gains, but nevertheless, still around that 26,000 level. In terms of, the movers then, on the Nifty, you have some of these steel names doing well, JSW Steel, Tata Steel, and, Titan is among the gainers, Power Grid, NTPC, BEL, HUL, these are some of the other gainers. On the flip side, TCS is the top laggard today. Interglobe Aviation extending losses from yesterday. Of course, Indigo has lost some market share in November on the back of the disruptions that took place. And, we are seeing that, play through on the stock prices as well, the loss in market share. But in terms of, the steel stocks doing well, there is some bit of news flow, which is leading to gains on some of these steel names. The DGFT has imposed an anti-dumping duty on non-alloy and alloy steel flat products for 200 days with effect from 21st of April 2025. So that's something that, the safeguard duty is in place for alloy steel and non-alloy, metals, which is why, you're seeing these kind of moves on some of these steel names. That's why JSW Steel, Tata Steel, all these counters are up in excess of 3 to 4%. Well, on that note, also take a look at some of the sectors then. Metals, of course, hands down top, sectoral movers today. All the other sectors as well doing well, real estate, IT, pharma. So yes, it is turning out to be a good New Year's Eve. Looks like the bulls have finally showed up for a New Year's party, and it's not the year-end blues that are at play today. But with that, completely timed out on this edition of Opening Bell. It's the last Opening Bell edition for 2025. Of course, I'll see you with Closing Bell as well at 3 p.m. But for Opening Bell viewers, wishing you a very, very happy New Year. I'll see you in 2026, 1st Jan. And hopefully, we will, start the year as well on a sanguine note. Have a good year. Wish you a very bright, positive and happy New Year, and a profitable one at that as well. And hope you manage to create a lot of wealth and, see a lot of gains in your portfolios as well. From me and the entire team, Thank you for watching. See you at 3 p.m. with closing bell.